All right. All right. So we changed mics, so hopefully that addressed the muffling sound online. Uh, I think my arms are gonna get a little bigger by the end of the day from holding this for all day, but we'll get through this. Uh, so again, I think we'll be starting 2 minutes early. That's a big accomplishment for us. It seems to be a few minutes behind. So anyways, we're gonna start with GASB update. Again, if my hand or if my arm goes down and you start not hearing me, please remind me. Sometimes I tend to do that. So we're gonna start with GASB update. Again, I have to get here to gain control. All right. So we actually don't have a lot of GASBs on the horizon, which is unusual. This year we have two statements, GASB 103 and GASB 104. And next year we only have GASB 105. So I mentioned that I have 27 years of municipal auditing experience, and I have never had 1 year where we had no new GASB to be implemented. But it looks like 2028 is very well on track for that we may have no standards to implement in 2028. So far, GASB have not issued anything past 105. I know that they are getting ready to issue some standards, but I doubt that they will be effective for fiscal year 28. So 28 is the year to plan your vacations and do all the fun stuff. All right, so today we're gonna spend most of the time talking about GASB 103. Obviously, it is the most significant standard. So we get started here with GASB 103, financial reporting model. And sorry, my animations are a little bit over the place. So scope is to establish new requirement or modify existing ones for the following. So some areas specific that are being impacted. First one is the MD&A. We're gonna talk in detail about the changes that are coming to the MD&A. Unusual or infrequent items, that's a minor change, modifying the extraordinary and special items that we used to have. New definition, new terms. Presentation of the proprietary fund statement of revenues, expenses, and changes in fund net position. So this is probably a significant area of GASB 103. If you are an entity that does not have any proprietary funds, then you are spared. You don't really have to worry about that. But for any of you who have an enterprise fund or an internal service fund, you will be impacted by that. Information about major component units in basic financial statements. So if you have discrete component units, how you display them, how do you break them down? We're going to talk about that as well. Budgetary comparison information, so some significant changes there. We're gonna go over some examples, but definitely more information needed for budgets in the financial statements. And then finally, financial trends information in the statistical section, just a very brief overview of what needs to be done in the statistical section as a result of those changes. So we'll start with the MD&A, and the MD&A basic principles. Provide easily readable analysis based on currently known facts, decisions, or conditions as an issuance date. So a lot of the information is pretty much the same. I tell a lot of my clients, if you are preparing your MD&A in accordance with GASB 34, you're probably going to have minor changes to do to your MD&A. If you were not preparing it in accordance with GASB 34 and it was more of a boilerplate type MD&A, then you're going to find yourself having to provide a lot more analysis, a lot more explanations. Written in a manner that can be understood by users with no detailed knowledge of governmental accounting. So just keep that in mind, that this is a document that is designed for people who either don't know government accounting or don't want to get into the detail. So this is supposed to be easy to read, easy to understand, let you know what happened during the year. Are you better off than last year without really having to get into the accounting terms? focus on current year compared with the prior year, with emphasis on current year. And then avoid duplication. So that's important that, you know, if you're analyzing the government-wide and then you're analyzing the fund statements, same explanation for both. You don't need to repeat that explanation. You can just refer to it. So try as much as you can to avoid duplication. And then finally, focus on the primary government and distinguish between the primary government and discretely presented component. So the primary government is your primary entity, not necessarily the discrete component unit. So the discussion has to be focused mostly on the primary government. Yeah. All right. And then as far as MD&A topics, so you don't really have a lot of flexibility there. You have to stay with the topics that GASB is requesting, no more, no less. So those are the topics or the sections that has to be presented. Overview of the financial statements, which you already have from the prior years. Maybe it's just some small modifications. Financial summary, you also have that basically the schedule of your statement of net position, your statement of activities, the comparison between the prior year and the current year. Detailed analysis. So that's the part that we're seeing a lot of entities don't have. Analysis is really focusing on providing the why, not just the what. So really going into the detail instead of just saying, well, general fund revenues went up by 10%, expenditures went down, that therefore fund balance changed or net position changed. That's not really the detailed analysis. You want to talk about the why, the factors that are causing the revenues to increase or the expenditures to increase, not just the fact that they increase. Significant capital assets and long-term debt activities. So we're going to talk about that, but really the idea is not just to list capital asset schedules and long-term debt schedules, but really talk about the significant activities that happened during the year. We completed this project XYZ. We took on this project, you know, ABC. We issued this new debt. Significant transactions that happened during the year. And then currently known facts, decisions, and conditions. So these are the 5 areas that you have to comply with. Those are the 5 areas that you have to stick with. You cannot add more. You can maybe add this in the transmitter letter or some other supplementary information, and you cannot have less than those 5 areas. Yeah. All right. So we'll talk about each one of them. Yes, sir.
Say on that. So, you know, in previous years, you know, in our MD&A, we would also discuss variations between budget and actual, you know, because we felt that that was really important in the MD&A, even though it was included in the financial, the part of supplement the information itself. But we also noted that in MD&A. And why is that specifically being excluded at this point? Because it seems to me, you know, for a reader of MD&A is not, you know, detailed in Italian, doesn't want to go through entire ACPR to figure out, you know, what's going on between budget and actual. They have excluded that, you know, in the MD&A. That makes no sense to me.
Right. Well, the question is, why is the budget comparison information or budgetary information excluded from the MD&A? I mean, the MD&A is still required supplementary information. So it is still part of the required supplementary information. It's just got moved from the MD&A to where the budget comparison schedules are. Before that, it was in 2 places where you have some narrative discussion in the MD&A about the budget. It was only in the budget for the general fund, versus what you have now is you have the budgetary comparison schedules, then you have the discussion of the fluctuations in budgetary information, not just for the general fund, but also all the major special revenue funds. I don't know if there was any other logic behind removing it, but that's as far as I know. The reason why. All right, so overview of the financial statements. Again, I mentioned that you probably already have that. It's an overview of the basic financial statements. Describe the report that you have government-wide, that you have fund financials, the relationship of each statement to another, the difference between the government-wide and the fund financials, focus on significant differences in the information the financial statements provide. So really describing what does the government-wide provide versus what the fund financials provide, and really focusing on those. Financial summary. So financial summary are the schedules that you normally have, condensed schedules that provide information derived from the government-wide and compare current year to prior year for both governmental and business type activities. So condensed really are very condensed information. So, current assets, capital assets, other assets, current liabilities, non-current liabilities. No need to go into the detail of the line items. Provide information needed to support the analysis of financial position and exhaustive operations. So this is really your starting point. Those schedules would compare the current year to the prior year, and it would show variances. Your job after that is to actually explain those variances. So the idea is that you start with a summary schedule, you show the variances, and then you go to the narrative, the detailed analysis, and you start explaining those variances. You don't have to explain every single line item, every single variance, but you have to explain the significant ones and provide a why. Why are these variances occurring? Okay. So, what needs to be in the financial summary schedule? Like I mentioned, total assets would be capital assets and other assets. So some of you may be used to having current and non-current. It's now capital assets and other assets. So you can't just have current and non-current. Capital assets needs to be separate. Deferred outflow of resources, liabilities. You would have other long-term and other liabilities and long-term liabilities. And then you would have the deferred inflows, and then the net position, and you would have the different categories of net position. So that's your statement of net position, and you would have it comparative. This is a schedule that most of you already have. Maybe just changing of the line item to capital assets instead of non-current assets, but otherwise, that's what most of you already have. So no change there. And then on the income statement or statement of activities, you would have the program revenues with the charges for services, operating and capital grants. Then you would have the general revenues by major source. That's your property taxes, your sales tax, and all the other revenues. Then you would have your expenses by function, the general government, public safety, and so on. Total expenses. Then you would have the excess of revenues over expenses. Then you would have contribution to permanent endowment and other permanent fund principal, transfers, unusual and infrequent items or infrequent items, beginning net position, change in net position, and ending net position. So again, this is the same schedule that you already have, just keeping in mind that there are new terms this year. So there are no special and extraordinary items. There are unusual or infrequent items. So those things need to be reflected in the MD&A tables as well. Right? So the detailed analyses in the government-wide, that's what you really need to provide. You need to provide significant changes to governmental and business type activities, explain why changes occurred and the magnitude, the why, not just the what. And this is really the most important thing, because every MD&A we review, if something is missing, it's usually the why. Of basically just providing the increases, providing the decreases, but not providing the reasons behind. So that's not the intention. Includes facts, decisions, or conditions that users may not be aware of. So that's a good place in the MD&A to discuss factors and that cause changes that the user may not be aware of or not be able to see directly in the financial statements. And then discuss policy changes and economic factors that significantly affected operating results. So rate increases, population changes, other things that may have affected operating results. And then you have the fund financials and significant changes to each major fund. So remember, the fund financials analysis has to be on major funds. You can't just discuss all funds. And again, we are reviewing all of our clients' MD&As, and we get to see that sometimes where the fund discussion just talk about all governmental funds and doesn't really distinguish the major funds. So really the requirement is to discuss the major funds. There is no requirement to discuss other funds. So just the major funds, major governmental and enterprise funds. So for each of them, you have to explain why changes occurred and their magnitude, include facts, decisions, or conditions that users may not be aware of, discuss restrictions, commitments, and assignments that significantly affect the availability of fund resources, and should focus on explanations that differ from the analyses of the government-wide. So keep in mind that oftentimes the analyses of the government-wide can be very similar to the funds. What caused the changes in the governmental activities are probably the same things that caused the changes in the general fund. So, I mean, not 100%, but there are definitely a lot of duplications there. So the idea is not to repeat the same information again, but you can simply just refer to the government-wide analyses and say, these are the reasons why the changes occur. So try to avoid duplication as much as possible. Okay? All right. So now we move to significant capital assets and long-term debt financing. So remember, the only thing that changed here is the word significant. So that tells me that you don't really, it's not just listing all your capital assets, but that's what we do currently in the MD&A, is just listing all the capital assets or all the long-term debt. But you really want to be talking about significant capital assets activity during the year, including intangible assets. So capital assets includes betas, include leases, include all intangible assets as well. Significant additions and disposals during the year, significant policy changes and economic factors, and should not duplicate any analysis already in the government-wide analysis. So again, significant projects completed, significant projects that were undertaken, disposition of property, like significant disposition of properties, changes in capitalization thresholds, things of that nature can be discussed here. It's similar to capital assets, also long-term debt, significant long-term debt financing activities, new debt issuance, refunding, retirement, so on. Agreements entered into, changes in credit ratings and changes to debt limitations that may affect the financing of planned facilities or services. Significant policy changes and economic factors. And again, do not duplicate any information you already explained in somewhere else in the MD&A. Right. And then finally here, currently known facts, decisions, or conditions. Descriptions of currently known facts, decisions, or conditions that are expected to have significant effect on financial position, or that are expected to produce significant differences from current periods. So examples.
Oh, I didn't know you get it as well.
And I cannot answer it, so I'm not sure why I'm getting it.
So examples, trends in relevant economic and demographic data, such as change in population, customer base, income level, building permits, enrollments, unemployment rates. These are currently known facts that can impact or impacted the current period results compared to prior periods. Relevant factors used to develop the subsequent year budget that will provide an indication of how results of operations are expected to change in the subsequent year, such as changes in tax rates or fees or things of that nature. Expected changes in budgetary net position, actions the government has taken related to post-employment benefits, capital assets, lease liabilities, and so on. And then also actions other parties have taken that would affect the government in subsequent periods, such as new legislation or regulations imposed on the government. So these are the currently known facts. So again, it has to be things that you already know and not necessarily things you think will happen in the future. That so it's just really focused more on currently known facts. Yeah. All right. So this is just a very quick comparison between your MD&A prior to GASB 103 and after GASB 103. And you will see it's actually not that much different. So it's not a very significant change. So discussion of the basic financial statements is not called overview of the financial statements. It's probably the same. We are reviewing and marking up all of our clients' MD&As from last year to help them modify it for GASB 103. And I want to say that probably on the overview of the financial statements, we had almost no comments. Besides maybe changing the title, the information is pretty much the same. Condensed financial information versus financial summary, again, same. The only difference is instead of current and non-current assets, now we have to list capital assets separately from other assets. Analysis of the government overall financial position and result of operations, detailed analysis. Again, if you were preparing your MD&A, was providing the Y in your analysis, you're probably not going to see much difference there. It's asking for very similar information to provide analyses, to provide the Y, not just the what. Analysis of the balances and transactions of individual funds. Again, that's combined now with a detailed analysis. So it used to be that you have, in the past, you had a section to analyze the government-wide, and then another section to analyze the fund statements. Now there's only one section called detailed analysis, and it's basically to analyze same information, the government-wide and the fund financials. Description of capital assets and long-term debt activities versus significant capital assets and long-term debt activities. Currently known facts, decisions, or conditions of future significance versus currently known facts, decisions, or conditions that basically impacted the current year or maybe next year budget. Analysis of budgetary variations. So this is gone. The budget does not belong in the MD&A anymore. So there is no more discussion of the budget in the MD&A. And then also, if you were using the modified approach for infrastructure, then you used to have information in the MD&A regarding your condition assessment and all of that. And that is no longer required to be in the MD&A. Okay? So those are the main things that were taken out of those last two parts, the budgetary information and the infrastructure information. Those were taken out of the MD&A. So some practical considerations. How should you prepare? How should prior year information be presented in the MD&A? And remember, GASB 100 said that when you are implementing new standards, you don't really have to restate the required supplementary information. And that's the same recommendation. That's actually not a recommendation, it's a requirement. You are not allowed to restate prior year numbers in the MD&A. Because when I say prior year, because you are doing a comparison between the prior year and the current year, GASB is not allowing you to restate the prior year column to reflect the same categories as the current year. So I'm going to show you what that means. So GASB 100 direct government not to restate prior year information in the RSI and supplementary information unless the prior year information is restated in the basic financial statements. So what does that mean? If you're a water district and you prepare a comparative financial statements, meaning that your financials, your balance sheet, your income statement always have 2 years, current year and prior year, and the audit opinion cover both years, then your MD&A will then need to restate the prior year information. So basically the MD&A for the information presented in the financial statements have to reflect be reflected the same way. So it has to be restated. But any years that is not presented in the financial statements should not be restated. So let's say you're a water district and you're preparing your 2026 financials. If you are comparative financial statements, then your financials include 2026 and 2025. Your MD&A is going to include 2026, 2025, and 2024. 2026 and 2025 will be based on GASB 103. 2024 will be based on prior standards. You're not allowed to restate 2024. So it will look odd, but that's what GASB wants. How GASB wants. The basis for conclusion for GASB 100 then talks about this not being an option, that we should not restate prior year information. So it's not a choice. You're not allowed to do it. So this is how it's going to look like. So it's going to look a little bit strange because you probably see here that you have new categories called non-capital subsidies for 26 and 25, but those categories didn't really exist for 24. So then you wouldn't show them. And then you used to have capital contributions, at other non-operating expenses, and then you have capital contributions at the bottom here. That used to be in 24. Now in 25 and 26, they're up here under other non-operating revenues. So GASB doesn't want you to move line items and make all the years presented comparable. They want to only the years that are presented in the financial statements need to be adjusted in the MD&A. So if you're a city, then that basically means that you only present 1 year in the financial statements. So in the MD&A, you're only going to have 2 columns, 26 and 25. 25 is not supposed to be restated to reflect the new categories. It will stay the same like prior year. Okay? All right.
On that question,
Yes.
I'm thinking about stuff. Once you have your basic financial statements, in the GASB format, like format. Has anybody ever touched around with using AI to create GASB compliant MD&A? What would it look like? Is AI intelligent enough to do that, or what do you think?
Well, I honestly don't know. The question is whether there are any AI tools to create an MD&A that is GASB 103 compliant MD&A. I honestly, I don't know. We use AI, but we use AI for auditing. We don't use it for financial statements preparation. I know that there are some products out there like Workiva and some other products where the MD&A gets updated as the numbers in the financials change. But I'm not aware of any AI that would actually just provide it from scratch. I am a fan of AI, but I definitely would be very careful. AI is a good starting point, but definitely the human factor is still needed, especially if you're providing analyses of what occurred and so on. But I'm not aware of like a specific product that is being used right now. There may be. All right, some other practical considerations. Advice is don't wait. Don't wait until October, November when you normally prepare the MD&A to prepare this year MD&A. Because especially if you feel that your MD&A requires a lot of work, you're gonna find yourself running out of time. So what we are doing and what actually GFOA is recommending is to mock up your 2025 MD&A for what needs to change, what needs to come out, what needs to be added. So that way, when you're working on your 2026, you already know what you need to do. As a complimentary service to our clients, we're basically in the process of reviewing all of our clients' 2025 MD&A and giving them comments on what parts or what sections they should remove, what sections require more analyses, and what the titles and headers and things needs to change. So definitely starting early. If you're a client of ours, we're probably reviewing your MD&A. If you're not a client of ours, probably maybe ask your auditors to do it. Or you can do it yourself, but definitely don't wait until October, November. Identify expectations and draft known analyses. So right now we're in July. Probably you already know a lot of the reasons why things changed, and you can start working on those analyses from now. Anything included but not required, clean it up, take it out. Remember, you have to stick with those 5 requirements, and then plan ahead for the remaining adjustments. If you know that there are some adjustments coming, then obviously you can be discussing that in your analyses. But the idea is try to start early. Don't leave it until October, November, just for this year, just because it's a little bit different this year. All right. I think we covered. For some reason, my animations spit out the slide first, and then it goes through the bullet points later. So now we're going to talk about unusual and infrequent items. So those are new, but they're not totally new. Like we had items used to be called special and extraordinary items. And they are now replaced with unusual and infrequent items or infrequent items. And they're actually less stringent when it comes to the unusual and infrequent. So these are transactions and other events that are unusual in nature or infrequent in occurrence. And unusual nature possess a high degree of abnormality and be a type clearly unrelated to or incidentally related to the ordinary activities of a government, taking into account the environment in which the government operates. So what does that mean when we say unusual items? For example, having flood for a city may be unusual, but having flood for a flood control agency may not necessarily be unusual. So it really depends on the nature of your organization to determine what's unusual for you. What was unusual for you may not be unusual for your neighbor. So another example that I use for unusual or infrequent is tornadoes. A few months ago, I think a tornado touched down in Fresno. That's unusual. But if you live in, Oklahoma, for example, that's not unusual to have tornadoes. So again, it's what relates to your organization. Is it unusual or infrequent to your organization? Infrequency of occurrence would not be reasonably be expected to recur in the foreseeable future, taking into account the environment in which the government operates. So again, very important that you're related to your organization and not necessarily to somebody else. Should present as the last presented flow of resources prior to the changes in net in resource flow. So really, this is at the bottom of your income statement. So after operating income and expenses, and after transfers, and after basically everything, all the way at the bottom, right before the change in net position, this is where the unusual or infrequent item would be. Inflows and outflows related to each unusual or infrequent item should be presented separately and not net. And then should disclose the program, function, or identifiable activity to which an unusual or infrequent item is related. So let's see what that means. So basically, before GASB 103, we used to have special and extraordinary items, and they had heavier, more demanding requirements to be met, versus now we have unusual or infrequent items. So what's the difference? Prior to GASB 103, we had special items, and special items had to be unusual in nature or infrequent in occurrence and within the control of management. So now control of management is gone. There's no control, doesn't matter whether it was within the control of management or not. Extraordinary items had to be unusual in nature and infrequent in occurrence, both. Now it doesn't have to be both. So now you have either an unusual item or an infrequent item, and it doesn't really have to be within the control of management. So again, a lot less requirements to qualify for an unusual or infrequent item compared to what we used to have before the special and extraordinary items. Okay. So this is how unusual or infrequent items would be presented, would be all the way at the bottom here. Where you see it's right after transfers and general revenues, and this is in the government wide. And you can see that we are not netting them up. So you have grant revenues, and then you have cleanup costs. So they are recorded separately. Yeah. And also on the fund statements, this is where they would be presented, would be at the bottom here, right after all the other categories, all the way at the bottom of the flow.
So I was gonna run a poll question in case.
Yes. Whenever we have poll questions, it stops my controls. So that's why I have to come back here and regain my controls by closing it. Right. Yeah. So just wanted to kind of give you an example of disclosure of unusual and frequent items. So this is an example where Sample City experienced a flood during March of 2025. There was a catastrophic event outside the control of management. The city incurred expenses to clean up the flood damage in the amount of about 10 million attributable to the function of public works and public safety in the amount of 8.8 million and 1.6 million respectively. Sample City also received 2.5 million in grants from the state to assist with the cleanup effort. So as far as distinguish between operating and non-operating revenues and expenses, oh, I'm sorry. Yeah, so that was just basically when you have an unusual or infrequent item, you can't just list it in the financials. We have an unusual or infrequent item, and then no discussion anywhere else. So you really need to go in the note disclosure and describe what is that unusual item and provide who is the department or the function that is really responsible for that. And basically a very brief description like this, but you just can't, because normally unusual and frequent items are material items. Otherwise, you would probably not bother putting it into a separate line item called unusual or infrequent. So it's usually material items. So if you have something material and you're calling it unusual, it does warrant some explanation in the notes. Yeah, nothing elaborate, but just a very brief paragraph describing what it is. All right. So now we move to the presentation of proprietary fund statements of revenues, expenses, and changes in net position. So when GASB 103 first came up, this sounded like a no big deal, like just a small change in definition and no big deal. But as we started digging deeper, we started realizing that there are all sorts of questions that came up as a result of this, to a point where actually GASB is ready to issue an implementation guidance only for subsidies and enterprise fund revenues and operating and non-operating items. I actually gathered a few Q&As from the implementation guide that GASB is getting ready to issue. Also, the GFOA had a few bulletins that we issued on this topic, and they had some Q&A as well. So I tried to gather some of those as well here in the presentation. So we will go over them as we speak. All right, so now we have to distinguish between operating and non-operating revenues and expenses. We actually always had to do that. It's just now we have new definitions of operating and non-operating items. Separately report non-capital subsidies. So that's a new change. So we're going to talk about what subsidies are. Transfers are subsidies. So now we're going to have to split transfers between capital and non-capital. Present the following information in the order shown using the all-inclusive format indicated. And basically, I know this is going to be a long slide here, but that's how long your income statement for proprietary funds is going to look. So you're going to start by operating revenues, and you would have total operating revenues. Then you would have operating expenses and total operating expenses. Then you would have operating income, operating revenues minus operating expenses. Then you would have non-capital subsidies. which is part of non-operating items. And you're gonna have a total for that. Then you're gonna have operating income and non-capital subsidies. Then you're gonna have other non-operating revenues and expenses. And another total. Then you have income or loss before unusual or infrequent items. Then you have unusual and infrequent items. Then you're gonna have increase in fund net position, then your beginning net position, and then your ending net position. So again, basically you have operating revenues and expenses. Then you would have non-capital subsidies. Then you would have other non-operating revenues and expenses. Then you would have unusual and infrequent items. Then you would have your end results. So again, multiple categories, and obviously some of them are new. So some changes here to the proprietary funds that will probably change your groupings in your financial statements. What used to be grouped as transfers now will have to be split between capital and non-capital. What used to be grouped as non-operating may have to change. And we're going to talk about operating and non-operating in the definition that GASB provided. So let's start here. Operating revenues and expenses. They actually have kind of a funny definition, saying they are revenues and expenses other than non-operating revenues and expenses. So that's the definition of operating. Anything that is other than non-operating. But basically what they did here is that instead of defining what operating is, what they're really doing is that they're actually defining what non-operating is. And then they're saying anything that is non-operating is then operating revenues. So the definition here is focusing more on what's non-operating, and then everything else would be operating, not the other way around. Why did they do that? Because non-operating used to be like a bucket where people would just put in anything that doesn't look like something they are used to or they like. So they would say, oh, that's non-operating. So you can have all sorts of stuff in non-operating, and now it's not gonna be the same. You only have 5 items that can go into non-operating. That's it. So what are these 5 items? These are the 5 items. Subsidies received and provided, contributions to a permanent and term endowment, revenue and expenses relating to financing, so interest expense, proceeds from debt, those kind of things. Resources from the disposal of capital assets and inventory, so any gain or loss on capital asset, and then investment income and expenses, interest earnings, interest, and so on. So these are the 5 categories that can be non-operating. If your item does not fall within those 5 categories, it cannot be non-operating item. So it will have to be not operating item, or maybe unusual or infrequent item. So subsidies is really a big thing here, and we want to talk about what is subsidy, what is the definition of subsidy, and so let's get into that. So let's talk about subsidies received, resources received, for which the proprietary fund does not provide goods and services to the other party, and that directly or indirectly keep the proprietary fund current or future fees and charges lower than they would be otherwise. So those 2 things have to be met, that the money that the proprietary fund is receiving, they're not giving any service in return. And that this money is directly or indirectly helping that proprietary fund keep their fees at this current level. That if they don't have those subsidies coming in, they would otherwise have to increase their fees. So a good example would be things like connection fees. Oftentimes, connection fees may have things built in to compensate your government for future expansion, or to reimburse your government for expansions you already did. So if those fees that are being collected, the customer is not really getting anything in return. Customer is not getting, like if you're a water customer, they're not really getting any water in exchange for paying those fees. They're really paying for you to expand the capacity in the future. But if the customer doesn't pay that fee, how would you pay for those future expenditures? You will then have to increase the rates on these customers in order to pay for those future expenditures. So that's what we mean here, is that it has to be that you're not giving any service in exchange, and also that it is helping you keep your fees where they at. Same thing with the resources provided, for which the other party or fund does not provide goods and services to the proprietary fund, and they are recoverable through the proprietary fund's current or future pricing policies. So if the proprietary fund is the one giving out the subsidy, it has to be that they're not getting any service in return, and that they are recovering those subsidies that they're giving through charges that they're charging their customers. So those two have to be met in order for it to be considered subsidies. And then all other transfers are also subsidies, like operating transfers and so on are all subsidies. So that's for subsidies. And when we look at a fund, we have to look at the principal activities. So what is operating for one activity may not be operating for another. So for example, revenues and expenses that otherwise would be classified as non-operating in most proprietary fund financial statements should be classified as operating revenues and expenses if those transactions constitute the proprietary fund's principal ongoing operation. For example, interest revenues should be reported as operating revenues by proprietary fund established to provide loans for first-time homeowners, which is consistent with the classifications in the statement of cash flows for certain loan programs. So that's going to be a question later. But basically what we're saying is that interest income for most operations are not operating activity. They are investing activity or non-operating basically. However, if the principal activity of that fund is to give out loans and charge interest on them, then that interest income now becomes operating income, not non-operating. However, a water fund, interest income for them will be non-operating. So what we're trying to say here is that it's not like we're saying interest income is always non-operating. It depends on the activity of the fund. For most funds, it will be non-operating, but for some, it will be operating if their principal activity is to loan money. So just wanted to show you here how these non-capital subsidies and other information are reflected on the income statement. So you can see here that we now have non-capital subsidies, and then we have other operating revenues and expenses, which also have some transfers. So you can see that the transfers now are broken into two: non-capital and capital. And we're going to talk about how do you determine if a transfer or a subsidy is capital versus non-capital. But this is a trick that we used to have all the transfers together at the bottom. Now we have to separate them to non-capital and capital. I also want to highlight that the non-capital subsidies are also non-operating items. That's why we're calling this other non-operating items. So we started saying non-capital subsidy and then other non-operating items. So those two really are non-operating. The non-capital subsidies and all the other items are all non-operating. It's just that you have to report the non-capital by itself and not combine them with other non-operating. Okay. So let's see. So this is again a comparison between pre-GASB 103 and with after GASB 103 of how the income statement is different. So pre-GASB 103, you can see that we had non-operating revenues that included basically property taxes, other investment income, lease revenue, and so on. And then we had a category called capital contributions and transfers. Now we're going to have a non-capital subsidy category that will include most transfers and the property taxes and intergovernmental revenues. But then we're going to have another category called other non-operating revenues and expenses. And this is where your investment income, your capital contribution, your remaining transfers that are capital related transfers will be recorded. You can see here lease revenue went up here instead of being down here. So again, this will depend on basically the nature of the operation of the fund. But just to give you a quick comparison of how your income statement used to look like versus how it's going to look like going forward. Remember, this is only for the proprietary funds. So this has no impact on governmental funds. Unusual and infrequent items apply to all. But the non-capital subsidy and all and operating versus non-operating, this is only for the proprietary funds, not the governmental funds. Okay. So I borrowed this from GFOA, and it's a decision tree to help you determine whether a revenue is a subsidy, is operating or non-operating item. Remember that what you're really trying to determine is whether an item qualifies to be non-operating or not. If not, then it's operating. So really, it's kind of going the other way around. You're not trying to figure out if an item is operating or not. You're trying to figure out if it meets the definition of non-operating, because they only have 5. So you just run through those 5 and see if basically it meets any of them. And for the most part, it's not going to meet, they're going to be very clear except for the subsidy one. That's the one that actually does require some digging and investigating. So I'm going to try to just kind of walk you through, you know, how it should be done. I'm going to maybe stand on this side here. So basically, you're trying to go through those questions. So the first question is it a non-operating revenues and expenses? So we said that non-operating are just 5 items, either contributions to permanent endowment, or revenue and expense related to financing, or investment income or expense, or resources or use from disposal of capital assets, or a subsidy. So you start first by asking, is it a contribution to permanent endowment? The answer is no. Then is it revenue relating to finance? The answer is no. Is it investment income or expense? No. Is it relating to capital assets? Disposal? No. Is it a subsidy? If the answer is no, I guess if it's a subsidy, then you would ask yourself a question. Are we providing goods and services or receiving goods and services? If the answer is yes, you're actually receiving goods and services or providing goods and services, then it's no longer non-operating. It goes up to be operating revenues. But if the answer is no, we're not receiving product, goods or services, then those criteria that we talked about before, as a receiver directly or indirectly keep fees lower than otherwise would be, or as a provider are recoverable through funds, current future pricing, and all other transfers. If the answer is yes, then yes, this is basically helping us keeping our fees where they are, and we're not providing goods and services for it, then it is a subsidy. And then you ask yourself, is it limited to capital? If the answer is yes, then it goes into basically other non-operating revenues. If the answer is no, then it goes into non-capital subsidy. I think all the other ones, if you had a yes answer here, yes, it's a contribution, or yes, it's revenue from financing, then the question here becomes, does it constitute the fund's principal ongoing operation? If the answer is yes, then again, it's operating revenues. If the answer is no, then it goes to other non-operating revenues. So I know that this may look a little overwhelming, but it's actually, once you get used to it, you're just trying to see any item, whether it meets the definition of one of the 5 items that were identified as non-operating. Contributions, or revenue and expense from financing, or from investment, or disposal of capital assets, or subsidies. That's what you're trying to determine. Is the item I'm evaluating meet any of those five? The answer is no, then it's operating. The answer is yes, then you have to have follow-up questions. Are we getting goods and services? Is it capital or non-capital to determine where in the non-operating should be reported? Okay? So this is how you would go about determining operating versus non-operating. That basically means that you need to go through your revenues of your enterprise funds and internal service funds to ask those questions. Do we have any revenues that are being reported as operating revenues that maybe shouldn't, that maybe should be moved to non-operating? So, we're going to be giving some examples here, but what we're finding is that there are sometimes fees that have a portion of it built in that really is not operating, that there is no exchange of service for that portion of the fee. And those are the ones that needs to be analyzed to determine whether they should be separated and moved to non-operating. Of course, and Mitesh is going to talk about the concept of materiality, that you always have to consider materiality when you're looking at these things. We don't want you to go and try to analyze a $5,000 revenue to determine should I move it to non-operating or not. I don't think that's the concern, but if you know something is embedded in our fee, every customer come in and pay 30% of the fee is going to something that they're not getting service in return. This is where you may want to take a look. Okay. All right. So talk about a few things that may get a little confusing. Connection fee. Amount relating to the cost of the actual hookup is operating revenue because the customer is getting something in return. You're hooking up their property to your system, so that's operating revenue. But amounts relating to expanding existing service capacity is capital subsidy because the customer is not really getting anything in return. You're actually just making them pay for your future expansion. So that would qualify as subsidy. So if this is all in one fee, then you're probably going to need to break out that fee into operating and non-operating. Landfill, not a subsidy due to the relationship between the fee and the services provided. Landfill services being provided to those residents paying the fee, and therefore it is operating revenue. Bond proceeds received from governmental funds for capital. If debt is restricted for capital and to be paid from governmental revenue, then it's a capital subsidy. So if you have a governmental fund that issue a bond and then the bond is restricted for capital purposes, and then they transfer some of the proceeds to an enterprise fund, those proceeds are basically capital subsidy because they are tied to the bond, which is restricted for capital, and they are going to be repaid back by the governmental funds, not by the enterprise fund. So therefore, they're subsidy. Because if they are to be repaid back from the enterprise fund, then they're just a debt of the enterprise fund. They're not a subsidy. When they get the money, they're not going to report debit to cash, credit to transfers. They're going to report debit to cash, credit to long-term debt because they are the one expected to repay. So, so it really has to be that it is kind of a transfer to determine whether it's capital or non-capital. So these are just some examples. I also wanted to talk about what qualify as limited to capital. So these are some examples of what qualify as limited to capital. A grant agreement that limits the award to capital. That's pretty straightforward. You have a grant for capital purpose. So any transfer of money to a fund is going to be for capital purpose. The provider fund can limit subsidies provided to another fund through the budget. So they can say that this is a budgeted transfer for capital. So that makes it for capital purpose. The authorizing legislation for a new customer fee for a utility enterprise fund that include an amount for recovery of prior capital or future capital. So that's obviously going to be subsidy for capital purpose. Enabling legislation for impact or developer fees are accounted for in an enterprise fund. Proceed of bonds or notes issued for capital related purpose. Other limitation by the proprietary fund as a subsidy provider or other limitation by the provider to the proprietary fund subsidy recipient. So I think the key here is there needs to be limitation by the provider, whether it's a grant agreement, bond agreement, or the actual fund providing the resources, imposing those restrictions, or the budget. But if you get a transfer that has no restriction, and then you choose to use it for capital, that does not make it a capital transfer, capital related transfer. It has to have restriction on it. The mere fact that you decided to use for capital does not make it capital related transfer. So just keep that in mind. All right, so these are some Q&As that I gathered from the implementation guide that is the GASB is getting ready to issue. Also from some of the GFOA bulletins that were issued regarding this matter. So this is a question here that says GASB 103 tell us that the interest revenues on loans issued by proprietary fund established to provide loans for first-time home buyers are operating revenues because those loans are the fund's principal ongoing operation. If the fund also incurs interest expense on money it has borrowed to enable it to make the loans, is that interest expense also an operating expense? Any thoughts? Answer is no. It is not, because this fund is not in the business of borrowing money. This fund is basically proprietary fund principal ongoing operations providing low interest loans. The interest expense does not arise from those loans, but from the borrowing the government has done to enable it. Thus, the interest expense is incurred for financing that is not the fund's principal ongoing operation and it's not operating. So it's just basically saying that the fact that they borrowed money to provide that service does not make this their principal operation. They did. There can be other, same like a government who borrow money to build a water facility. That's not part of their business to borrow the money. It's just to provide water. So it's kind of the same concept. Then here you have a question about if a proprietary fund's principal ongoing operation is to lease out the government's own property, such as for economic development purposes. Is the interest income portion of the lease payment received an operating revenue? It's a tricky one. The answer is no. The proprietary fund's principal ongoing operation is to convey the right to use the government's property. The interest income derived from providing financing to the lessee is non-operating. Their business is not to provide financing to the lessee. Their business is to convey the right to use properties to the lessee. The fact that they're allowing them to finance it is a different thing. It's not part of the standard operation. So actually, interest income here would be non-operating item. But what about in the same situation, would the proprietary fund or BTA, which is a business type activity, lessor recognize the lease income that arises from amortizing its deferred inflow of resources as an operating revenue? So remember, when you account for leases receivable, they are offset by deferred inflow. And you amortize that deferred inflow over the term of the lease, and you recognize lease revenue. Is that lease revenue operating? And the answer is yes. The revenue from amortization does not meet any of the criteria to be reported as non-operating, and thus defaults to being reported as operating revenue. So see here, the idea is you have those 5 categories of non-operating. If you don't meet any of them, it is by default operating. Yeah, so the default goes to operating unless it meets one of the 5 criteria to be non-operating. Okay. And it actually makes more sense because they are in the business of basically providing those, conveying those rights. So the amortization of the actual lease is operating. Financing it is not. All right. And one last question here. If a proprietary fund receives a subsidy that the grantor has not restricted for capital assets, but which nonetheless is used for capital assets. Is this capital or non-capital subsidy? I think I answered that. And the answer is it's non-capital subsidy. Subsidies are classified as non-capital subsidies if the provider or the subsidy either does not limit the use of the resources or limit the use of the resources to something other than the acquisition of capital assets. Okay. And I said the last question, but it was not last question. How should subsidies be classified if the provider of the resources limit the use to debt service for capital-related debt? And in this circumstance, subsidies should be classified as capital subsidies because the use of the resources is limited by the provider to the debt service for capital-related debt, which is capital in nature. So, just to give you an idea about how to determine capital versus non-capital. And then one last question here. GASB 103's definition of operating revenues and expenses can include items that do not meet the criteria to be included in operating cash flows. How should government address this? So, for example, that example about the interest income and the leases or the loans. Interest income on the operating statement will actually be operating revenues. But when you go to the cash flow statement, it does not meet that definition. So you would have items that are reported as operating in the income statement, but not as operating in the cash flow statement. So in this case, the items that are included in the statement of revenues, expenses, and changes in fund net position of a proprietary fund or a standalone business type activity as operating revenues and expenses, but that belong in other classifications in the statement of cash flows should be included in the reconciliation of operating income to net cash flow provided by operating activities. So you would have to show that item at the bottom of the cash flow statement when you reconcile operating income to net cash provided by operating activities, because it is not going to be in the net cash provided by operating activities, but it's in operating income because it was reported as operating revenue. So you would have to take it out of operating income in that bottom reconciliation in the cash flow statements. For a lot of you who don't prepare the financial statements, that's probably going to be your auditors dealing with those issues. But as a reviewer, obviously, of your financials, you still have to be aware of those. Yeah. Another thing that this is impacting is major fund determination. So in the past, we based the major fund determination on operating and non-operating revenues or expenses. But we always excluded the capital contributions and transfers. Those were not included in determining major funds. And now that capital contributions and transfers category is eliminated, and the items that used to be there are now either in non-capital subsidy or other non-operating revenues and expenses, we now have to include them in the major fund determination. So we're still doing the 10% test and the 5% test, like 10% of revenues or expenses or so on, and the 5%. Those are the criteria to determine whether a fund is major or not. So those are still the same. It's just a question of 10% of what and 5% of what. That base changed. It didn't used to include capital contributions and transfers, and now it does. So in my opinion, what this do to you is that it actually makes it harder for a fund to become major. Because then they have to meet higher base that now that we're including the capital contributions and the transfers in there. So in order to get to 10% and the 5%, you actually have to meet a higher amount. So it's not going to create more major funds. I think in most cases it's going to have probably no impact. But if anything, it will probably create less major funds if it will impact. Thank you.
Okay, this should work now.
Okay. All right, so proprietary funds transfers in and out and capital contributions are classified as non-operating. and governmental funds, other financing sources are excluded. So we always excluded governmental funds, other financing sources. So other financing sources is the part that has transfers in, transfers out, proceeds from debt. This is excluded from determining the major funds. But on the proprietary funds now, transfers are included. So it's actually inconsistent treatment where in the governmental funds, we don't include transfers, in the proprietary funds, we do include transfers. Yeah. All right. I think that's it for the proprietary funds display. Any questions so far? Yes.
Question, so the categories on the proprietary statement are very specific, right? Are those the exact same ones that we see on government-wide? Because proprietary is kind of really different.
The question is that proprietary fund categories are very specific. Are they going to be the same categories that we would have in the government-wide? Is that the correct answer? The correct question? The answer is no. The government-wide still retain the categories of program revenues, general revenues, and then transfers at the bottom. And if you have unusual and infrequent items, it will also be at the bottom. So on the government-wide, you would not have anything called non-capital subsidies, for example. The government-wide is also not broken between operating and non-operating. It is really broken between program revenues, general revenues, and then functional expenses. So that stays the same. Only the proprietary fund income statement categories are changing. Okay. All right. So now we're going to talk about major component units in the basic financial statement. So component units, we're really talking about, like the discrete presented component units when they are presented separately next to your primary government, how those should be displayed. So we're basically saying that you have to present each major component unit separately in the statement of net position and activities if it does not reduce the readability of the statement. So currently we can basically just have a one column called discretely presented component units. And this column can be made out of 10 component units. And we just have this one column. And then we can display the breakdown in the notes. Well, now we are not allowed to do that. Every major component unit, and we talk about what is major, have to be displayed separately. If it does not reduce the readability of the statement, meaning that if you're gonna make it that it doesn't fit, you have to fit it on 3 different pages, it becomes very hard to read, then you don't have to do that. But what you're gonna have to do is you're gonna have to have a supplementary statement to break it out. So let's see what this. So if presenting each major component unit separately reduces the readability of the statements, combining statements of major component units should be included in the basic financial statements after the fund financial statements. Almost the same like when you have non-major funds, you have one column, and then you go to supplementary information, you have a breakdown of that one column into the different funds. So it'll be the same thing with the major component units. If you cannot break them out on the face of the statement, then you will have to have a separate supplementary statement to break them out there. So, major versus non-major discretely presented component unit. No dollar threshold for determining which one is major. So there's really no, I know everyone would like a dollar amount, but there is no dollar amount. You would have to really use your professional judgment to determine that. Also, no disclosure describing the designation as major or non-major. So you don't have to disclose that. Government use professional judgment to determine, and the criteria are the type of service it provides to the citizens, engaged in significant transactions with the primary government, significant financial benefit or burden to the primary government. So those are the things you want to consider to determine if a component unit is a major component unit or not. If you have a component unit that is just really providing very minor services, it's nothing of significance, there's really not a lot of financial burden on the primary government, then it's not a major component unit. But if you have something, like housing authority, or then obviously we're talking about a different situation. But remember here that we're talking about discretely presented component unit. So we're not talking about blended component unit, because those are already part of your primary government. So there's really no concern here, but we're talking about the discretely presented component unit. A lot of you don't have them. But we have several clients that do, like Richmond does, like Berkeley does. So we have several clients that have these discretely presented component unit, and we have multiple of them. So the question is, how do you display those? Column for each one is what's required, unless it becomes hard to read. Then you one column for all of them, then a supplementary statement in the back to break out that one column. Yeah. So how does that look like? It looks like this. So this is a situation where we couldn't break it out because it would impact the readability of the statement. So this is the government-wide, and you can see that we only have one column for the component units. And also the same situation was the income statement, where we only have one column for the component units. This is the government-wide, okay? Then you go to the supplementary statement. See, this is a combining statement of net position. And you can see now, these are the two major component units, and the other non-major, you don't have to break them up, okay? So this is, remember, this is not part of the government-wide, this is really a supplementary statement. Will be in the back of the report. And then same situation with the income statement, where you would have also basically the major component units and the non-major one. Yeah. And then you'll see them here as well for the expense side. So again, probably not a huge item for a lot of you, but for those entities that have discretely presented component unit, and if you have more than one, this is when you're going to have to make those determinations. Yeah. All right, budgetary comparison information. So this is tweaking, and you know, hopefully for I'm hoping that this is going to be a deterrent for some organizations that tend to like to have too many major funds, that they're going to realize that they're going to pay the price for that. And maybe that will make them cut back on the major funds. And what I mean by that is that I'm talking about organizations that voluntarily choose to report funds as major when they don't meet the criteria to be major. They are still allowed to do that, but they're just going to have to provide a lot of budgetary information relating to those funds that may deter them from having to do that. So, budgetary comparison are presented as RSI in the general for the general fund and each major special revenue fund that has legally adopted annual budget. So, couple of things. If you are one of the organizations that present your budgetary information as part of the in the body of the financial statements, and by that I mean that they are not in RSI, but they are right after your fund financials, then before the note disclosure. That's part of the basic financial statements. I know a few cities that I have that do that, and that is not going to be allowed. So if you present your budgetary schedules as part of the basic financial statements, you're going to have to move them to the RSI. It used to be optional, now it's a requirement that they have to be in the RSI. That's one thing. Separate column for the variances between original and final budget. That's new, because you used to have a variance only between final budget and actual results. So that's new, original and final budget. Then final budget and actual results, that's what we had before. And then, yeah, this is also new. You have to provide explanation of significant variations between original and final budget amounts and final budget amounts and actual results. So now you have to provide, well, before you didn't have to provide anything. You just provide the variance column and that's it. Maybe some discussion in the MD&A about the general fund, but that's it. You didn't have to provide any other explanation of budgetary fluctuations. Maybe a no disclosure if you overspent your budget, but that's it. Now you're gonna have to provide explanation for the changes between the original and final budget and between the final budget and actual results. When we say significant, the idea is not to explain every line item. But GASB, like always, they're not gonna tell you what is significant. So you have to determine that yourself. Professional judgment has to be used. I tell our clients, you can use a similar approach to what we use. When we ask you to provide us an explanation of variances, we normally evaluate which accounts we want to get explanations for. So we set thresholds, percentage of change, and dollar amount. So if an account, for example, changed by 10% or more, doesn't automatically trigger an explanation, because that change by 15% may still be a small dollar amount that is not worth investigating. And also a change by for a big dollar amount may not be big as far as percent. You may have $1 million change in property taxes, but it represents 1% increase. So that also does not trigger a reason for providing explanations. But if you have a change that is more than 10% and the dollar amount is also significant, those are the ones that you want to explain. So the idea is to come up with what is that percentage and dollar amount that I want to use. And every fund should be different, because obviously every fund have different materiality and so on. Excuse me. I mean, we obviously can work with you. You can run your assessment by us of whether those thresholds are reasonable or not. But really trying to find that right balance of not providing too much information that makes it not very useful, but also, not setting thresholds that, you're basically not providing any explanation. You really want to find that right balance of providing explanation for the real significant items that has fluctuated or changed. Right? So how is the original budget defined? The original budget is the first complete appropriated budget, even if adopted after the start of the fiscal year. The original budget may be adjusted by reserves, transfers, allocations, supplemental appropriations, and other legally authorized legislative and executive changes before the beginning of the fiscal year. Should also include actual appropriation amounts automatically carried over from prior years by law. And then the final budget is defined as the final amended budget is the original budget adjusted by all reserves, transfers, allocations, supplemental appropriations, and other legally authorized legislative and executive changes applicable to the fiscal year, whenever signed into law or otherwise legally authorized. So these are just kind of boilerplate definitions of original and final budget. And then this is how the budget comparison would look like. You can see that we now have two variance columns, original over final budget, and then final budget over actual amounts. Remember that those actual amounts have to be budgetary basis. So when you're in a budgetary schedule, you always have to use budgetary basis. For most of you, your budgetary basis is the same as the GAAP basis. But for a few, their budgetary basis is different. Like, for example, some they consider encumbrances to be expenditures for budgetary purposes. So on the GAAP, that's not an expenditure. So when you're preparing this schedule, you should be including encumbrances as part of your expenditures if you use budgetary basis. And then you provide a reconciliation at the bottom to reconcile to GAAP basis. In this situation, there were no reconciling items, but I'll show you other examples where there are reconciling items. All right, so again, this is another example of how the schedule would look like for another fund. So this, the one before was for the general fund. This is for the special revenue fund. And then this is how we envision the explanations would be provided. So we are already starting to format our financial statements to incorporate those templates in there, so the client can then provide explanation. You can see that on this example, for example, we have the general fund and the special revenue fund, and then we talk about the budgetary revenues, budgetary expenditures, and then the unusual and frequent items. This would be an example of having budgetary basis and differences with GAAP basis. So you can see here that we have a column for budget to GAAP differences, and the standard wants us to show what's being added or subtracted between the budgetary basis and the GAAP basis. So in this case here, most of the changes were on the expenditure side, and then it's reconciled here at the bottom. So you can see that 57,000 matches the 57,000 of changes. So this will only apply for organizations that have budgetary basis, that use budgetary basis. If you use GAAP basis for budget, then you wouldn't have to worry about those types of reconciliations. Yeah. Another way to present those reconciliations is like this, where you basically show the revenues or resources inflows, and then difference with budget to GAAP, and similar with the expenditures, where basically you add and subtract the things that are in GAAP but not in budgetary basis, and vice versa. Yeah. All right, and then the last part of GASB 103 is the financial trends information. And this is, we're talking about the statistical section. Because remember, especially if you're an enterprise activity, if you're like a water district or a sewer district, or your statistical section is based on these revenue categories of operating, non-operating, and now you're going to have new ones, non-capital subsidies. You have new categories. So what are you going to do with the previous years? Or you normally, display 10 years of information. Are you supposed to go back and revise all 10 years? Or what exactly are you going to be doing? If you recall, this happened before, when we implemented GASB 54 for fund balance, restricted, committed, assigned, and unassigned. We didn't go back 10 years and revise fund balances to those categories. We actually, if you look at statistics, I think it's been 10 years now that maybe it dropped. But during those years, we had some years that had reserve, committed, reserve, unreserved, and then we moved to the new categories of other years. So that's what we're expecting to have. In a statistical section of separately issued financial reports, governments engage only in business type activities or only in business type and fiduciary activities should present revenues by major source for their business type activities, distinguishing between operating, non-capital, and non-operating revenues and expenses. So I'm going to skip what he said here. And then basically, this is an example of a no disclosure. Believe it or not, if you're implementing GASB 103, there can be restatements. If you're doing so. This note will show the restatements, and what we're talking about is restatements in the categories. You didn't used to have non-capital subsidy, now you have it. So are you restating the prior year information? And the no disclosure is discussing that. So for fiscal year, so this is an example, for example, it's the change in accounting principle. For fiscal year 2026, the government implemented GASB 103, which resulted in changes in the presentation and classifications of revenues and expenses in the proprietary fund statement of revenues and expenses. And then you're basically listing what those changes are. Because remember, GASB 103, GASB 100 talks about restatements and the fact that you have to disclose those in the financial statements. But restatement doesn't mean that your fund balance or your equity change. Restatements also apply to the line items change from last year. So that's why it has to be disclosed, even though that your fund balance or your net position may not have changed. Okay. and you can tell here, you can say that the implementation did not result in a restatement of beginning net position. You still have to show what have changed on the proprietary side. And this is basically the conclusion of GASB 103. Any questions? Maybe I can take questions from.
Just one question. There's a from online. I guess there's a unusual or infrequent item have to be material to be disclosed, or can an immaterial item also be disclosed as an unusual or infrequent item?
So the question is, do unusual and infrequent item have to be material in order to be disclosed, or can you have an immaterial, unusual, and infrequent item? I would say that it should be material. I think it was with everything in the financial statements, materiality is a key. Question is, do you really want to put an immaterial item in a separate line item in the financial statements and have a no disclosure for it? It's definitely not worth the effort. I would say that you should really only consider those items when they are material, and oftentimes they are material. But if you had an unusual situation where that involved $500 or $1,000, I definitely would not even consider putting it into a separate line item. So my opinion would be that only material items should really be considered.
That's it.
That's it. Okay. Any other questions here? Yes.
It's more about actually internally for auditor. So currently for our audit work paper, in the initial phase of year end, we always review whether which fund is member fund, and then we ask client to explain based on our materiality to explain the budget, final budget to actual analysis. But right now in our audit work paper, do we also need to add a column for original budget and split the difference between original and final budget? That exceeds the material amount from our session.
Well, thanks for the question. Maybe audit questions we can discuss in more detail within our firm, but the question is really now that we have disclosure, the financial statements between original and final budget, should we be doing audit procedures and part of our analytical procedures to look at the fluctuation between original and final budget? And I would probably say no. First of all, budgetary information is unaudited in the financial statements. So we as auditors really have no responsibility over this budget information other than reading them as any other RSI and making sure that there is no major inconsistency. If we feel that investigating original versus final budget fluctuation provide us audit evidence of some sort, then sure. But if not, then I wouldn't necessarily do it just because it's in the financial statements. Yes.
Did you or will you provide the slides to us electronically who attended?
I did late last night.
Late last
So, you had to read before me, then you didn't get it. But if you didn't receive it, please let us know, and we'll be happy to resend. But we did email all the materials last night. Okay. Yes.
So, if the local government establish a materiality, but that materiality is higher above the audit materiality, and as a client or an entity, you prefer not to disclose it, but in audit terms, you would like to, so what are the next steps for that?
Definitely, the auditor can always question the client determination of materiality. We had situations before where a client decided that their materiality for some type of capital assets was going to be $5 million. And clearly that was a clear intention of not recording any transaction relating to those types of assets. So when we feel that that's the intention, obviously we have to interject and provide our opinion. It's a little tricky because it's an unaudited part of the financial statements. So if we, like the client really is adamant about sticking with that, we can give advice that this is probably not what the financials was intended for, but it wouldn't impact our audit opinion since we are really not opining on this part of the report. But definitely, we would always recommend to our clients what the spirit of the standard is and what the intention is, and if we feel that they're missing it, we'll definitely recommend for them to change the material. I'm not sure if we can force them. Obviously, when we are talking about an audited number and the client is using a materiality that seems too high, we control that by our audit opinion, that we feel that, okay, this can cause the numbers to be misstated. But with the RSI, with the budget, I don't think we have the same power, but definitely, I think most of our clients, their intention is to meet the standards and to provide, transparency to the reader. So I don't really anticipate a client trying to come up with an astronomical materiality to avoid providing explanations altogether. But if it is, we would definitely be advising them not to do so. All right. Well, the next two standards are actually very simple. So maybe I don't want to jinx it, but maybe one time in my life I'll finish early. So we'll see. Every time I say that, I find something to talk about and end up being late again. All right, so GASB 104 is also due this year, and that is focusing more on capital assets, focusing on a specific type of capital assets, intangible assets. So we'll talk about what GASB 104 is requesting us to do. Okay. All right, so separate disclosure for certain capital assets. The following capital assets and related amortization should be disclosed separately. The capital asset no disclosure is required by GASB 34. So remember, GASB 34 does require capital asset no disclosure. It's a 10K schedule that shows your beginning balance, your additions, your retirements, your ending balance. That schedule is broken out by type of asset. So you have non-depreciable, land, CIP, depreciable, you have building, equipment, basically all the different types of assets. And for each of those, you have also accumulated depreciation, beginning, additions, deletions, and ending. So you have accumulated depreciation for building, for equipment, for machinery, and so on. In a nutshell, GASB 104 wants you to do the same for intangible assets. That's really what it is. So these assets reported in accordance with GASB 87 are covered under GASB 104. Intangible right to use assets recognized by an operator, that's GASB 94. The triple P, the public-private partnerships. Subscription assets reported in accordance with GASB 96, those are the SPETAs. And then intangible assets other than those above by major class of assets. Intangible assets that represent the right to use a type of underlying assets should not be disclosed in the same major class as any own assets. So what does that mean? Basically, they want to see your intangible assets same way you're doing it with your regular assets. So if you have lease assets, they want to see lease equipment, lease buildings as separate categories. And for each of them, they want to see accumulated amortization, lease equipment, accumulated amortization, lease building. If you have own building and lease buildings, they cannot be combined. So you would have buildings, those are your regular owned assets. Then you would have leased buildings as intangible assets. You would have accumulated depreciation for buildings. You would have accumulated amortization for leased buildings. So they need to be, basically you're doing the same for intangible assets that you're doing for capital assets, breaking them out by type and providing the disclosure, the beginning balance, the additions, deletions, ending balance, same like you do with regular capital assets. You cannot mix them together. You cannot say equipment owned and leased in the same line item. It has to be owned equipment, leased equipment. Owned accumulated depreciation for equipment, leased accumulated amortization for.
What about if the equipment is is a right to use asset, and it's also there's leased portions and there's SPITA portions of equipment. Can that be combined, or should leases be in one line and SPITAs be on another line?
Usually there is no for the same equipment.
Well, like, if you include software in equipment, then you'll have, like, the police cameras have software components and have.
So, SPITAs are its own line item. Like, you don't have SPITA equipment or SPITA, building. It's just, SPITA is an information technology arrangement. So that is gonna be its own. It's the least ones that will have separate categories. Okay. So another part of GASB 104 that initially, excuse me, when it first came out, it actually caused some concerns, but then GASB did clarify that that's not what they really meant, was capital asset that is held for sale. Initially, when this came up, everyone thought about property held for sale. And there are a lot of funds that hold properties for sale that are not part of your capital assets, that are actually in the fund itself. Like a governmental fund have an asset called land held for sale, or land held for redevelopment, or property held for sale. Initially, when GASB 104 came out, we thought, oh, they don't want us to report these property held for sale. There was actually a Q&A in the implementation guide that talked about that, about removing those assets held for sale from the fund. But then that question was removed from the implementation guide. And I actually reached out to GASB and I asked them, were you planning on issuing more clarification about this matter? I said, no, we took out the question because we basically what you're trying to say is that we're not trying to determine whether an asset is a capital asset or not. We assume you already determined that. GASB 104 is really focusing on things that you already determined that they are capital assets. So we're not talking about, the property held for sale that's in your governmental fund. That's inventory. That's treated the same way as inventory, lower of cost or materializable value, and is not considered a capital asset. It's not considered an investment of any sort. It's just inventory. So just wanted to make that distinction because there were some confusion because remember, GASB 72 said when you buy an asset, you have to make a decision at the time you purchase the asset, whether this is an investment or a capital asset. And you cannot change that decision, even if the use of the asset change in the future. But this is a one-time decision, and there is nothing in between. It's either a capital asset or an investment. There is nothing in between. So then the question came up, what about all those property held for redevelopment and for resale that are sitting in these funds? Are they investments, or are they capital assets, or are they somewhere in between? And initially, the discussion was like, you can only have investments or capital assets, so there's nothing in between. But then GASB came back when I spoke to them. He said, no, we may in the future chime in on that, but for now, you don't need to change anything. Those property held for sale that are sitting in your governmental funds are just considered to be inventory. So they are accounted the same way as inventory. They're not part of your capital assets. They're not an investment. They're just inventory. I know, for example, some cities, like I know City of Ontario, Southern California, they had hundreds of millions of dollars in property held for redevelopment. Hundreds of millions. So we're not talking about 2 million or 5 million, we're talking about maybe 150 million worth of these properties. So for some organization, this could have been very significant, but as of right now, no change to that. We're really only focusing on what you already determined to be capital assets. So if you have something that you already determined it was capital assets, it was in your capital asset list, now you're putting it up for sale. What should you do? And it's only a disclosure, shouldn't do anything else. It's just a disclosure. So if the government has decided to pursue the sale of the asset, and it is probable, likely to occur, that the sale would be finalized within 1 year of the financial statement date. So this has to be met, that you're actually putting the asset for sale, and it is probable that it would be completed by the end of within 1 year. Okay. Factors to consider when evaluating whether it's probable that the sale will be finalized within 1 year of the financial statements include the following. Whether the asset is available for immediate sale in its present condition. If you basically said, oh, we're gonna sell this land. Oh, but we have to clean it up because it has all this toxic stuff in it. Well, that makes it probably not likely that you're gonna be selling it within a year of the financial statement. Whether an active program to locate a buyer has been initiated, which may include the asset being put out for bid. Market condition for selling that type of asset. If you're basically saying, yeah, I'm gonna sell the Golden Gate Bridge, great, but are there any potential buyers for something like this? Or because obviously you can't just say, well, I think I'm gonna sell it within a year, when it's something that really there are no buyers for this type of assets. So it has to be that market conditions allow for this to happen and regulatory approvals needed to sell the asset. So if you really need to have to go through a lot of regulatory approvals and you don't have any of them, then probably it's not likely that this is going to happen within a year. So these are factors to consider. Again, we said not limited to, so obviously there's professional judgment on whether you think this is something that is probable or not. And there can be other factors to consider as well. So a government should evaluate whether a capital asset is a capital asset held for sale each reporting period. And then a capital asset held for sale should continue to be reported within the appropriate major class of capital assets. So no one is saying that because it's held for sale, that you have to do anything different, other than disclosing that it's held for sale. But you have to continue to depreciate the asset, continue to keep it as part of your capital asset listing. No changes there, just a disclosure that this is held for sale. No disclosure, separate disclosure of historical costs and accumulated depreciation, the carrying amount of the debt for which capital asset held for sale are pledged or as collateral, and the disclosure should be made for both governmental and business type activities. So, for example, here, this is your capital asset schedule, and you can see that there's really nothing out of the ordinary here, just a regular capital asset schedule. And then you will have a small disclosure like this, just saying that, you know, we are holding this building for sale. The buildings are reporting the governmental activities. They have a historical cost of 8 million, accumulated depreciation of 5 million, and they're pledged as collateral for about 1.5 million. That's the information that needs to be disclosed. You know, oftentimes those assets may not be pledged for anything, and all you have to do is just put the accumulated cost and accumulated depreciation, and that's it. All right, and that's GASB 104. So for the vast majority of you, you're probably not going to have to deal with asset held for sale. And all you have to do is just update your capital asset schedule to make sure that you have the breakdown by type for the intangible assets, and that's it. GASB 105 is also very simple, is about subsequent events. So we have a definition of subsequent events or transactions or other events that occur after the date of the financial statements, but before the date of the financial statements are available to be issued. It's what they call the subsequent events time frame. So June 30 is your financial statement date, and the date that the financial statements are ready to be issued, maybe December 15th. This is the period where you're looking for subsequent events. Yeah. The date of the financial statements are available to be issued is the date at which the financial statements are complete in the form and format that complies with generally accepted accounting principles, and approvals necessary for issuance have been obtained. So just make sure that we understand what do we mean by available for issuance, not just because we just got a first draft that doesn't make it available for issuance. Also, if for some reason everything got approved, but then we issued it like 2 months later for some reason. So it is really when all GAAP requirements have been met and the approvals to issue the financial statements have been obtained. This is the date, from the fiscal year end date to that date. Yeah. The dates through which subsequent events have been evaluated should be disclosed in the notes to the financial statements, which is actually consistent with the private sector. They have to disclose that. That date should be disclosed regardless of whether there is a recognized event or a non-recognized event. And we're going to talk about recognized and non-recognized events and what they mean. But you're going to have a note disclosure in your financial statements, regardless, to say that management has evaluated subsequent events up to that date. And this evaluation may have resulted in no disclosure and no subsequent events identified, but you still have to have that sentence in there. So recognized events provides evidence of conditions that existed at the financial statement date that inform accounting estimates reported as of the financial statement date. Accounting estimates reported as of the financial statement date should reflect the condition that existed at that date, including conditions substantiated by recognized events. So basically what we're saying here is that recognized events are things that you actually have to report before you issue your financial statements. You have to go back and approve. So if you have a receivable and customer owed you, as of June 30, they owed you $1 million. Now it came September, and you find out that this customer filed for bankruptcy. You're gonna have to adjust those receivables because the receivables existed, and now you know that this customer is filing for bankruptcy. So it will impact your receivable. That's called a recognized event versus an unrecognized one, are the ones that actually you have to disclose. So non-recognized events is a subsequent event that results in a significant effect, favorable or unfavorable, that is recognized or disclosed in the basic financial statements in the reporting period in which the event occurs, and is one of the following: a debt-related transaction, a government combination or disposal of government operation, a change to the legally separate entities that compose the financial reporting entity, a transaction or other event that is of such nature that the information items in the notes are essential to the user analysis for making decisions. So basically, it has to be one of those four. Was really the last one, kind of bringing in basically everything that can be material that happened during that period. But those are what we refer to as non-recognized events. And I want to give you an example. It's a little long, but hopefully it will kind of make it clear. So the bankruptcy of a water utilities major customer during the subsequent events time frame, which is from fiscal year date until the date the financials are available, may be indicative of a deteriorating financial conditions that existed at the financial statement date. In this circumstance, the water utilities financial statements as of the financial statement date should incorporate that event into the measurement of its uncollectible accounts receivable or accounts receivable. Because the customer already owed you the money as of June 30. And now after June 30, you're finding out that they filed for bankruptcy. So you cannot go back and adjust your receivable. You know that this is not a good receivable. Yeah. Conversely, if that customer, instead of experienced a major casualty, such as a fire or flood during the subsequent events time frame, such an event would not be indicative of conditions that existed at the financial statement date. Therefore, in that circumstance, the measurement of water utilities uncollectible accounts receivable as of the financial statement date should not incorporate the effects of that event. Such a subsequent event should instead be evaluated to determine whether it constitutes a non-recognized event. And what that means is that basically you're trying to determine, should I disclose this as a non-recognized event, or should I book it as a recognized event? Say the disclosure only applies to non-recognized ones, because the recognized ones you already booked. So they're already in your receivable, in your payable. The non-recognized ones are the ones that you're actually trying to bring to the attention of the reader by putting a no disclosure on. So one where the customer filed for bankruptcy, it indicates that these are conditions that probably existed at the financial statement date versus suffering a catastrophic loss after the financial statement date. It's clear that those conditions did not exist as of the financial statement date. So notes for the financials, a description of the non-recognized event and its effects. So you can see here, we're talking about non-recognized events. Remember, recognized events, no disclosure. You already recognized it. An estimate of the amount of the effect of the non-recognized event, or the reason why an estimate of the amount cannot be made, should correspond to the reporting units in the financial statements, and information that is the same for more than one reporting unit should be combined in a manner that avoids unnecessary duplication. And that's pretty much it. Any questions on 105? So as you can see, once you are done with 103, 104 and 105 are very simple. They're disclosure statements, and 20, and there's no other standards after that. So hopefully 27 is going to be very easy next year. It's just this one subsequent event standard to be implemented, and 2028 so far no standards. So hopefully for the next 3 years, there's going to be some reprieve. Having said that, this is what GASB is working on. That's what's coming your way. So we actually covered that implementation guidance update. Some of the Q&A, this is the one regarding subsidies. So a lot of the Q&As we covered today are coming from that implementation guide. The going concern is, I think I may have lost.
Oh, sorry.
Oops. Okay, got it. The going concern, uncertainties, and severe financial stress. This is really something that is coming because currently we have what we call going concern, where we give going concern opinions to government. Going concern usually means that we don't believe that they can survive. But that's not really the case with governments. Governments do survive. They can file for bankruptcy, but they don't disappear. They don't exist. So they're very different than private businesses. And that's why GASB is starting to focus more on severe financial stress rather than going concern. Because oftentimes governments, I can tell you that I give several going concern opinions throughout my career. I mentioned it was like, I spent 27, 28 years doing that, and these governments are still around. So I know that they don't just disappear. So I think this actually makes more sense that, several times, one time I gave a going concern to a client, and they came back to me and they're like, do you really think we're not going to be around next year? I'm like, no, I know you're going to be around, but that's what the standards require us to do. So now it's going to be focusing more on severe financial stress, defining, what does that really mean, inability to pay bills and things like that. But going concern is a different story. Doesn't really apply to government as much. Sometimes they do, but most of the time, government still continue as a going concern. They're working on infrastructure, revenue and expense recognition, digital assets. So there you can see they're definitely keeping busy, but as of right now, I would say probably the infrastructure asset one would be, and the going concern one would be the one come as new standards. But nothing has been issued yet. That concludes my presentation. 4 minutes before time. Well, I guess not yet. Questions?
Yeah, I just have a quick question going back to subsequent events. We implemented 103 early, and some of the items that we typically would talk in the MD&A also made its way to subsequent events, vice versa. I wanted to avoid duplication. What causes one to go in one place and not the other?
Well, so I can see that a subsequent event can be in the MD&A under currently known facts and conditions. and also it's required by GASB 105. But GASB 105 has not been, unless you early implemented that, okay. So there may be duplication there because the MD&A still requires currently known facts and conditions, but the subsequent event under GASB 105 is still required. So there can be duplication between the two.
Is one more detailed than the other?
I would say that probably the note disclosure should be more detailed. At least from our perspective, we audit the note disclosure, we don't audit the MD&A, so we would definitely be scrutinizing the note disclosure more than scrutinizing the MD&A.
Correct, got it, thanks.
Of course. Any questions online?
None, but just adding to it, to his question, you could probably reference, just adding to your question, you could probably add a reference to the note disclosure
Yeah.
and then have a briefer explanation in the MD&A.
Right. All right. Any other questions? All right, so it's around 11 o'clock. We'll take about 15 minutes break. And when we come back, I know Katerina and Doc Fryer, I saw them here. They have a presentation for us on pension and OPEB updates. Thank you.